Wall Street banks are stealing our money. If Wall Street's motto isn't to take the most amount of money from the most amount of people in the shortest period of time, it should be, because that's exactly what they do on a daily basis. Hold on, folks, because here we go. Hi, welcome to Financially Intact. Making money is easy, keeping it is the hard part. It is absolutely true that we have to at least have some of our money in the stock market. And I will give you my formula for doing that in just a little bit here. But first I want to take a couple of minutes to prove to you that although I believe in the stock market, I don't trust the Wall Street banks any further than I could throw them, and neither should you. Here are a few details to prove my point. So let's start here with an official notice from the Department of Justice. J.P. Morgan Chase & Company agrees to pay $920 million in connection with schemes to defraud precious metals and U.S. Treasury markets. For over 8 years, traders on J.P. Morgan's precious metals and U.S. Treasuries desks engaged in separate schemes to defraud other market participants that involve thousands of instances of unlawful trading meant to enhance profits and avoid losses. That's from the Department of Justice. From the Commodity Futures Trading Commission, they put it this way, that they're paying the fine for manipulative and deceptive conduct and spoofing that spanned at least 8 years and involved hundreds of thousands of spoof orders in precious metals and U.S. Treasury futures contracts on the commodity exchange. So you might be wondering, okay, what is spoofing? So we have two of it. First, spoofing, a general definition of the word spoofing, means to hoax, trick, or deceive. When it comes to financial spoofing, the definition for financial spoofing is a disruptive algorithmic trading activity employed by traders to outpace other market participants and to manipulate markets. Spoofers feign interest in trading futures, stocks, and other products in financial markets, creating an illusion of the demand and supply of the traded asset. In an order-driven market, spoofers post a relatively large order of limit orders on one side of the limit order book to make other market participants believe there is pressure to sell or to buy, if you go on and read the rest of that. So what they're saying is if J.P. Morgan wanted to buy precious metals, then they would put in a huge order to sell precious metals at a price that nobody would actually fill the order. But when the other companies see that, J.P. Morgan is trying to sell all these shares, that must mean something's wrong, the prices are going to go down, let's sell out now, and save what we can. And so, of course, when everybody jumps in and starts selling, that drives the price down. And of course, that's exactly what J.P. Morgan wanted, was a lower price so that they could buy into the market. Once they've done that, they get rid of the make-believe fake orders, and they've come out smelling like a rose. Well, they did this thousands and thousands of times. And they're not the only ones, and that's not the only way that they've been stealing money from the markets one way or the other. Let's look at Bank of America first. I'll get to Wells Fargo here in a minute. But Wells Fargo or Bank of America, they've paid some huge fines over the years. September of 2014, $7.65 million. August of 2014, they settled for $16.65 billion in fines. July of 2014, another $650 million in fines. This one is later on. I don't remember the year on this one. I'd have to look that up. But that was another $42 million fine for a thing that's called masking. And that's what is masking? It's fraudulently routing clients' stock trades. In other words, they're making sure their trades get in before their clients' trades. If they see a lot of clients are trying to buy into a market, then they're going to buy those stocks first, and then they'll sell out of their own inventory at the higher prices to their own clients. That's how they take care of their clients, folks. And this is the way most of the Wall Street firms will act and do it over and over and over again. We're going to get to that in just a second. So here's one of my favorites. Wells Fargo. It's fined $3 billion. This is, you probably remember that they were creating all kinds of fake accounts to make their books look a whole lot better. They were just creating accounts in people's names, savings accounts and charge card accounts that people never asked for and things like that, and they got charged $3 billion. Well, I love this one almost the most is because my granddaughter is going to college in North Carolina, and so we went to go throw $100 into her checking account for her, so she has a little bit of extra spending money. Wells Fargo says, "Oh, we can't take cash." I go, "What do you mean you can't take cash?" They go, "Well, we can't take cash unless you're on the account. Are you on the account?" I go, "No, it's the same last name, and it's not like we have a common last name." And they would not take cash. I go, "Why can't you take cash?" And they go, "Well, it's because of money laundering." I go, "Oh, so grandparents trying to put $100 into their grandkids' accounts as money laundering? That's your definition of money laundering? You really think money launderers do this $100 at a time?" Go, "You guys are nuts." What it is they just don't want to bother with it. So we have to put in a check, and we're going to get to this because what they're after, like all the big banks on Wall Street, they're after a cashless society so they can make more money off of every transaction that we make. So anyway, these are just some of the examples, but my real point here is, okay, you just saw it was billions and billions and billions of dollars between all the banks. Where are they making all that money? They have to be making that money from somewhere or else they'd be out of business. Most of us couldn't do a few $1,000s in fines and still survive. And yet they do billions of dollars in fines almost on a yearly basis, and they're surviving. Where are they getting all that money? They're getting it from you and me because they're stealing it from you and me. So you might ask, how are they getting away with all this, and why do they keep doing illegal things? Well, for one, the SEC, even the Department of Treasury and all that, they get a lot of their funding through the fines that they get to charge against the banks for doing illegal or improper things. So it's pretty much we have put the wolf in charge of guarding the hen house. That's how they make their money so that they could keep doing what they do or whatever. And they give these guys slaps on the wrist. And the banks, they keep doing it because they know they're making more money than they'll ever pay in fines. How did this ever come about? How could we have gotten so screwed up that this is just a way of life anymore, especially on Wall Street? If you go back to 1933, we had a law that came into effect. It was called the Glass-Steagall Act. And the reason that came in was because of the Great Depression. And back in the Roaring 20s, the 1920s this time, not the 2020s, but back in the Roaring 1920s, banks owned both the banks on Wall Street and they owned the banks on Main Street, kind of like it is today. And so what happened is people were borrowing money from Main Street banks to go invest into the stock market. Well, the banks didn't care because they loaned the money to the person from this bank and took it right back in on this bank, and they made money on both ends of the deal. And so they were actually loaning money to people to go put into a crazy stock market. It was at ridiculous heights. So after the Great Depression, the government studied the situation. They saw, oh, here's part of the problem is the banks were loaning money to people that they shouldn't have been loaning them that money, and the people were putting it right in the stock market, and that made the stock market go hog wild nuts. And eventually, when it all fell apart, the banks ended up holding all the money and the people had nothing. So they passed the Glass-Steagall Act and said, okay, we're going to have two forms of banking. We're going to have our Wall Street banks, and they will take care of investment banking. And then we will have our Main Street banks, and they will take care of personal banking. So that's your checking accounts, your savings accounts, your loans for your cars, your loans for your houses. That has nothing to do with the Wall Street banks. Wall Street banks are investment banks. They will take care of loaning money or raising money for businesses and stuff like that. Worked for almost 70 years, till 1999. Now they will vehemently deny that these two things have anything to do with each other, but just follow the time sequence and you'll see it can almost not be any other way. So in 1999, somehow the banks, and there is a story behind that, but I'm not going to go into that right now, but the banks convinced Congress that the Glass-Steagall Act was no longer necessary, that they could behave themselves, that they could be both Wall Street banks and regular banks. And since it's all banking, all deals with money, it ought to be put together all into one nice package, and Congress should let the banks do as they dang well please. And so the Glass-Steagall Act was eliminated. It no longer exists. Sure as heck, Sure as heck, 7, 8 years later, we had the Great Recession. Why? Because they had Main Street banks, were now also Wall Street banks, and they decided to loan money to anybody who could breathe to buy a house, whether or not they had the income. They were not verifying information for income. They didn't care. If you could breathe, you could buy a house. And that's what led into the great housing bubble. And of course, then once things started to fall apart, all these people, they really couldn't afford the houses. They never should have bought them in the first place. And then because the housing prices were so inflated because of the bubble, it really got out of hand. And of course, you know what happened after that. You know, housing prices in many areas dropped by 50%, and it took years and years and years for that to come back. I'm telling you that happened because of the Glass-Steagall Act and because they took it away and they let Wall Street banks become Main Street banks. And look at it again today. They lie, they cheat, they steal, they do it on a consistent basis. They do it on a daily basis. On a daily basis, they find ways to manipulate the markets to take money out of your pockets and put it into theirs. That's why when I say my channel, Financially Intact, is all about helping you keep your money in your pockets, that's exactly what I mean. I know it's tough to do because you have these professionals out there, and what I mean by professionals is they are professional at taking money out of other people's pockets and putting it into their own pockets. I have absolutely no use for the Wall Street banks. Okay, I'm done with my ranting and raving. Let's get on to how should you determine and how should you set yourself up in your investments? Why do I believe in the stock market, and why should you have at least some of your money invested inside of the stock market? So I want to show you, I'm going to show it to you here on the screen in just a second, but this is a sheet, and I will be glad to send one of these out to you. This is the history of the SPY. The SPY is the tracking stock for the S&P 500. So all the way back from 1950 all the way through 2018, this is the history of it. And I'll bring it out here on screen for you so you can see it in just a second. But if you want a copy of this, if you want me to send you a copy of this, here's how you do it. Either email me at my email address and saying, please email me the S&P 500 report, or you can call my office and ask for the report and give us your email address and we'll email this out to you. So my email address is ron@ronsoffice.biz, B-I-Z, as you can see there. The office number is 303-776-0867. So if you want a paper copy of this report, well, not a paper copy, electronic copy of this report, give me a call and we'll send it right out to you, or just send us a quick email. Now let me show you this close up here on the screen. Okay, so here's the report that I've put together, tracking the SPY, which is the tracking stock for the S&P 500. You can actually buy the SPY. It's an ETF, and you just put in the letters SPY, and you can see that you can buy it. So anyway, this is starting in 1950, because that's when the S&P 500 actually came around, or the SPY anyway, the tracking stock for it. Came in being. And so we have it from 1950 all the way through 2018. You'll see that here in a second. So anyway, we have the first date. Now all these numbers came off of, if you want to go double check it yourself, these are the opening and closing prices for each year, and I got it from Yahoo Finance. You could go in there and then put in for SPY and then hit for historical quotes. And you can see, and you can set that up by day, by month, by year, or whatever. And as you can see, I did it obviously by year. And so then I put them in, and then I put in the calculations. So just for example, 1950, it opened at $16.66. It closed at $20.77. There was a change of $4.11, positive change, and that was up by 24.67%. And so I put a 1 in the winning column. This column here is the losing column. This here is how much we won by, this here is how much we lost by, which are the same as these numbers here, but you'll see why I did that here in a minute. So then at the end, we did that for all 60, almost 70 years here. It's like 68 years, I guess. because these are the numbers that I wanted in the end. I wanted to see what this looked like at the end. And as you can see, out of all those years, I guess it was 69 years. So there was 51 winning years, 18 losing years. So that means the market was up 72.5% of the time. The market was down 27.5% of the time. Now remember I said I'd show you why I did this. This tells us our percentage of ups and downs on the average. So our average up was actually 16.43% of the time, and our down years was 12.64. Now, don't misread that. These are an average over 60-some years, basically, because we obviously have some gains that are much larger than 16 and much smaller than 16. Many losses, many times, are much larger than 12, especially when you put them together in a grouping. This is 2000 through 2003. And you look at it all together, yeah, our average is 12 per year, but when you have 3 losing years in a row like that, you have 46% of the money has, 46% of your money basically has disappeared. So, you have to take all of that into consideration when you're adding these things. This was back in 1973 and 74, 2 years in a row, 46% again. So you have to watch those downturns. But this brings up the whole point of how I believe that you have to have money in the stock market. The worst part about having money in the stock market is when you have to take it out when it's down. If you never have to take it out while it's down, you're probably going to be okay, because as you can see, after it goes down, it comes up. After it goes down, it comes up. After it goes down, it comes up. So the market up till now has always come back. So the trick is you have to give it time to come back. You do not want to take your money out during one of these bad times. So how do we avoid doing that? Well, let me explain that to you right now. So here's my philosophy on how we should be investing. Because like I said, being in the stock market, we know it's going to go down at times, and that's basically okay. The problem is we don't want to have to be taking money out when the market is down. And sometimes that happens. I mean, sometimes we have to take money out. Either the government says we have to take money out because it's IRA distributions, or perhaps the car blows up and we have to go get a new one, or whatever the case may be. There are times when we need to take money out. We don't want to be forced into taking money out of a down market, because then we have locked in those losses and we've taken away the opportunity for that money to come back. So what I suggest to people, and first and foremost I have to tell you, I do not have the license to tell you to buy anything into the market. I'm not telling you to buy the SPY. I'm not telling you to buy any individual stocks, bonds, or whatever. I'm just telling you how I look at it from my point of view, and being in the market, you decide how you're going to be in the market, or get your financial advisor to decide exactly how you'll be invested inside of the market. These are just general thoughts. I am not telling you to buy or sell anything because I don't have that license. So anyway, so if I have money in the stock market, then I also want a fair amount of money, maybe not an equal amount, but a fair amount of money in something that is safer, that will not go down. So whether that be U.S. Treasuries, or just a savings account, or fixed annuities, or fixed indexed annuities, there's lots of options you can have over here. And we'll talk about all those someday, but not today. So anyway, then when the market is down and we have to take money out, say for our RMDs, our required minimum distributions from IRAs, the government says, well, you have to take $5,000, $10,000 out of those accounts this year. Well, if you also have some here in a fixed account, then you can take the money during the bad years out of this account, and that satisfies the government, and you did not lock in a loss. By doing that, by taking money from here in the bad years, that gives this money time to come back, because the market always has come back, so it probably always will come back. Can't guarantee it, but most likely. And so what we have to do is we have to have a way to give our stock market money time to come back when it's down during bad times. So once again, have some money here, have some money here. During the good times, we take our money out of the market. It's always good to buy low and sell high. So if it's high, take some of the money off. You have to take it out anyway. Go ahead and take it from there. During the bad times, leave this pot alone and take the money from the fixed safe pot. So that's how I explain to people how I think that they should have their monies set up. Like I said, we'll get into it some other day. One of the choices I like for the safe money is those fixed indexed annuities, because you earn a reasonable rate of return, better than what you'll get in the banks on the average, but you never take a loss. So on the average, they're going to average maybe in that 3% range. They're never going to get you rich, but they're never going to get you poor. And the whole point is, now we have a place where we could park some of our money, earn something on it, a little something anyway, and we could take the money out during the bad times from there, and that gives our other money time to come back. So I hope you enjoyed this video. If you did, please like, please subscribe if you haven't already subscribed to the channel. We have new information coming out for you every week, sometimes twice a week. As always, thanks for watching.